Private markets go global. Blackstone, Partners Group, and the illiquid empire. Midtown Manhattan. You walk into a tower of glass and steel. The reception desk is minimal, the logo discreet but unmistakable. Blackstone. Upstairs, in conference rooms with views of the Hudson, people are not arguing about quarterly earnings or next week's stock moves. They are talking about the toll road in Spain, an office park in Texas, a portfolio of warehouses outside Berlin, a loan to a mid-sized manufacturing company you have never heard of in a town you will never visit. This is not the stock market. This is the world of private markets. Firms like Blackstone have turned it into an empire built on one very specific trade. You give up the right to sell whenever you want. In exchange, you get access to assets, structures, and return drivers that are hard to reach in public markets. Illiquidity is not a side effect here. It is the product. Now zoom across the Atlantic, across green hills and lakes, to a campus outside Zug in Switzerland. The building is modern but not flashy. Concrete, glass, wood. Inside, the rhythm is quieter, but the logic is familiar. People are looking at mid-market companies, solar farms, student housings, private loans. The name on the wall is Partners Group. Different continent, different accent, same underlying business. Convincing large pools of money that they should accept long lockups, limited transparency, and slower pricing in exchange for what the brochures love to promise. Higher returns, smoother returns. Returns that are not as tied to the daily mood swings of public markets. Together, firms like Blackstone and Partners Group helped scale what we might call the illiquidity empire. A parallel ownership universe, global in reach, industrial in process, and largely invisible to most people whose money feeds it. Let's take the fog out of the term. Private markets is an umbrella, but the core is simple. Assets that do not trade continuously on public exchanges. A privately held company. A building or a portfolio of buildings. An infrastructure concession. A loan that sits on one lender's books rather than being turned into a public bond and traded in a market with a live price every second. But these assets do not trade all day. Their prices are not constantly discovered by millions of buyers and sellers. Instead, they are valued periodically through appraisals, models, comparable transactions, and negotiation. That sounds boring until you realize it changes everything. Who can buy the assets, how it is financed, how it is governed, and how it feels to hold it. If there isn't a price flashing every second, volatility becomes less visible. Not always less real, but less visible. That psychological difference is one of the secret fuels of private markets. Institutions like the calm of smooth lines on a quarterly report, even if the underlying world is still full of risk. Blackstone starts smaller than its myth. It is 1985. Stephen Schwarzman and Peter Peterson, both veterans of Lehman Brothers, set up a new firm in New York. At first, it is an advisory shop, mergers, acquisitions, corporate strategy. But Schwarzman sees something deeper. Advisory fees are good, but they are episodic. You get paid when a deal closes. Ownership fees are different. Ownership fees compound. If you manage capital, you earn management fees year after year. If the assets perform, you earn carried interest, a share of the upside. And if you build vehicles with permanent capital, you can keep earning even when the deal cycle slows. So, Blackstone moves from advising the players to becoming one. It raises private equity funds, builds real estate strategies, expands into credit. It becomes a multi-asset alternative manager, a platform with many engines. Not one bet, a whole factory of bets. The structure that powers this factory is both elegant and slightly ruthless. You have limited partners, LPs, so pension funds, endowments, sovereign wealth funds, insurers, increasingly wealthy individuals through feeder vehicles. And you have the general partner, the GP, Blackstone, Partners Group, the manager. LPs commit capital, but they typically don't hand over the full amount on day one. They sign a commitment, often for 10 years or more. Then, GP calls capital as it finds deals. Capital calls matter because they change the rhythm of investing. Your money isn't fully deployed immediately. It's drawn down over time. Early years can look ugly on paper because fees start before exits do. This is why private equity has a famous J-curve. Performance often dips before it rises, as investments are made and fees hit before the big returns arrive. The GP charges a management fee, historically around 2% in the classic stereotype, though in reality it varies and has evolved. Often, it's charged on committed capital early on, then shifts towards invested capital later. And then there's the price, carried interest, the share of profits the GP earns if returns clear a threshold. This is where the finance becomes architecture. Many funds have a hurdle rate, a minimum return LPs receive before the GP takes carry. They have a waterfall that governs who gets paid, when, and how much. They have clawbacks and catch-ups, and all the machinery designed to align incentives, or at least to claim alignment. It sounds like paperwork until you realize it shapes behavior. Carried interest is why exits matters. It's why firms care about when and how they crystallize gains. It's why refinancing can be almost as exciting as selling a company, because recapitalization can return cash to LPs, while the GP keeps control and keeps the clock running toward eventual carry. The caricature of private equity is leverage and layoffs. Sometimes that is part of the truth, but it is not the whole mechanism, and you can't explain why this industry scaled globally without understanding the full set of levers. Private equity returns usually come from 4 broad sources. One is operational improvement. Real, sometimes boring work. Improving procurement, tightening working capital, raising margins, upgrading systems, professionalizing sales, expanding into new geographies, changing pricing strategy, integrating acquisitions. In the best cases, private equity ownership functions like a concentrated board that can push change faster than a public company can. Another is multiple arbitrage, buying at one valuation multiple and selling at a higher one. This can be timing, it can be market luck, it can be narrative, and sometimes it's just that you took a messy business and turned it into a cleaner one the market is willing to pay more for. Another is leverage. That amplifies equity returns when things go well, because you put less equity in and still capture upside. But leverage is also a blade. It narrows the margin for error, and in downturns it turns stress into crisis. And then there is governance, the lever that sits underneath the others. Public companies have dispersed owners and a constant spotlight. Private equity-owned companies have a concentrated control. Decisions can be made quickly, strategy can be coherent, management can be incentivized with equity, and management can also be replaced without a public spectacle. That governance shift is one of the biggest reasons institutions buy private markets. They're not just buying cash flows, they're buying a control architecture. Blackstone, in particular, builds a reputation as a real estate machine. And real estate is where the idea of illiquidity becomes tangible. Because a building is the opposite of liquid. You can't sell 3% of a warehouse in an instant. You can't click market order on an apartment complex. Real estate returns are driven by things you can't explain like a mechanic. Occupancy, rent growth, operating costs, financing rates. Valuation is often anchored by cap rates, the relationship between a property's net operating income and its market value. When interest rates rise, cap rates often rise too, pushing values down unless income grows enough to offset it. This is why the same building can look brilliant in a low-rate world and strained in a high-rate one. The cost of capital is the atmosphere real estate breathes. Blackstone becomes influential not only by buying buildings, but by buying portfolios and platforms and themes. Logistics warehouses as e-commerce scales, data centers as cloud computing grows, rental housing as affordability tightens, hotels as travel cycles recover. It turns macro trends into allocations and executes at industrial scale. And because the ownership is layered through funds, SPVs, which stands for Special Purpose Vehicles, and holding companies, tenants often don't see the true owner. The building might have a local property manager, a familiar brand, and the leasing office. But the economic engine above it is a global fund. That's private markets in one sentence. Real things owned through abstract structures. Another pillar of the illiquidity empire is private credit. And this is where private markets quietly start to resemble a parallel banking system. Banks, especially after the global financial crisis, face stricter capital requirements. Many pull back from certain kinds of lending, particularly loans that are complex, lower rated, or require balance sheet appetite. Into that vacuum step private credit funds. They lend directly to companies and sponsor backed deals, often at floating rates, often with bespoke covenants. These loans have features that sound technical but matter a lot. Floating rate structures mean the lender's income rises when base rates rise, which can be attractive for investors but can also squeeze borrowers. Covenant packages can include leverage tests, interest coverage ratios, restrictions on dividends, and requirements to provide detailed reporting. Some deals use unitranche structures that blend senior and junior risk into one instrument, simplifying the borrower's capital stack while giving lenders a customized risk-return profile. This is not just a footnote, it changes who controls corporate lifelines. A company that once negotiated with a relationship bank may now negotiate with a fund manager whose incentive system is built around fund performance and risk management, not cross-selling other services. Private markets are no longer just owners, they are creditors, and creditors have power. Now back to Partners Group. Founded in the mid-1990s, Partners Group grows up in a world where institutions are increasingly dissatisfied with a plain vanilla portfolio. Stocks can feel volatile. Bonds can feel insufficient. Traditional banks retreat from some types of lending. And the global surge for yield pushes allocators toward assets that feel less correlated to daily markets. Partners Group positions itself as an architect and allocator across private equity, private debt, infrastructure, and real estate. It becomes known for wrapping a messy world of private assets in a process. Sourcing networks, committees, portfolio construction frameworks, and risk systems designed to make illiquid investing feel controlled. It often focuses on the mid-market. That detail matters because the mid-market is where private capital can be deeply operational. These are companies that are too big for small investors, too small or complex for public markets, and often still in phases of professionalization, succession, and expansion. Partners Group's pitch has a Swiss flavor: patient, structured, methodical. Disciplined access is the product. It is the same underlying trade as Blackstone, but in a different wrapping. In investment committee rooms, illiquidity premium is spoken like a law of physics. Investors should earn extra return for accepting that they can't exit easily. But the premium, when it exists, is paying for specific burdens. Time risk. You may be forced to hold through downturns. Valuation uncertainty. You don't get a clean market price every second. Complexity and access. Private deals require negotiation, legal structuring, and governance, plus operational involvement. It can also pay for scarcity. Private deals are not infinitely available. If you have access to a better funnel, better relationships, better execution, you may earn more. Yet the premium is not guaranteed. If too much money floods into private markets, returns compress. 100 funds bidding for the same data center portfolio push the price up and the future return down. Private credit spreads tighten when capital is abundant. Infrastructure valuations rise when every pension fund wants inflation-linked cash flows. Illiquidity alone does not create alpha. It creates friction. The premium exists when you are being paid to bear friction that others can't or won't. When the room gets crowded, the friction becomes a shared experience, not a paid service. This is why these firms evolve constantly. New strategies, new geographies, new fund structures, secondaries, continuation vehicles, co-investments. They're always looking for a next pocket where complexity still pays. Private markets also have a psychological feature that institutions love and critics distrust: smoothing. A stock that falls 30% in a week screams at you. A private asset that loses value often whispers. Because it is valued periodically, quarterly, monthly, sometimes through appraisals that lag reality. The method can be reasonable, but the result is stepwise. This makes volatility look lower, and lower apparent volatility is valuable to institutions that must report performance and maintain stakeholder confidence. But smoothing can also delay recognition of pain. In private markets, problems sometimes surface not when the asset is marked down, but when refinancing becomes expensive, when covenants bite, or when liquidity is needed and the assets can be sold quickly without taking a hit. Private markets can look stable right up until they have to become liquid. The stress fractures in the illiquidity empire show up most clearly in vehicles that offer more frequent liquidity while holding illiquid assets. Some funds offer periodic redemptions, monthly or quarterly, often with limits. In calm times, that seems like a nice compromise. Illiquid returns with a liquidity window. In stress, those windows can become bottlenecks. Investors request more redemptions than the fund can meet without selling assets at bad prices. The outcome is predictable. Gates, queues, limits, the fine print becoming real life. This is not necessarily fraud. It is the mathematics of liquidity mismatch. A fund that owns buildings and private loans cannot instantly create cash without selling or borrowing, And selling in a panic is exactly what the structure is designed to avoid. As private markets grow, these dynamics matter more systemically. Not because private markets are inherently dangerous, but because a large enough parallel system can create its own cycles, its own crowded trades, and its own versions of runs, just slower and dressed in a legal language. Here's the part that makes the story real. The money feeding the illiquidity empire is not only billionaire wealth, it is teachers' pensions, civil servants' retirement funds, university endowments, insurance pools backing annuities. Ordinary people are indirect LPs. They may never hear the words capital call or waterfall, but a portion of their future depends on these machines working. This is why private markets are not a niche anymore. They have become part of the back-end architecture of institutional savings. In the best version of the story, that's a good fit. Long-term liabilities matched with long-term assets. Patient capital funding patient projects. In the worst version, it's a system that promises patience but delivers trapped money and opaque risk. The difference is not fate, it's design, governance, and honesty. It is tempting to tell this story as a shadow conspiracy because the ownership is invisible and the jargon is dense. But the more useful framing is structural. Private markets grew because they solved real problems. They provided capital when banks retreated. They funded long-duration assets that don't fit well under quarterly public market incentives. They created governance structures that can, in some cases, improve companies faster than dispersed ownership can. They provide a channel for long-term savings to build long-term infrastructure. In the best cases, this is not parasitic. It is productive. The challenge is keeping the system resilient and fair, aligning liquidity promises with asset reality, preventing leverage from turning ordinary downturns into crisis, improving transparency so investors understand what they actually own, and ensuring that long-term value creation is not just a slogan, but something you can measure in operational outcomes. These are hard problems, but they are solvable problems. The industry is already evolving under pressure from regulators, investors, and its own experiences of stress. The machine is learning. And now we turn from the quiet empire to the loud surface. Private markets giants like Blackstone and Partners Group like to say they invest in real world, away from the glare. Warehouses, toll roads, companies, cash flows that move slowly. But there is another class of player that lives in the glare. They trade the surface of the system. Currencies, interest rates, stock indexes, commodities. They can go long or short, move fast, and place bets that show up in headlines the same day. They are hedge funds. And within that universe, one species has become legend. Macro funds. The ones that look at countries the way stock pickers look at companies, the ones that treat a currency peg or a central bank promise like a weak joint they can test. Two names, more than almost any others, have become shorthand for that world. George Soros, Ray Dalio.